Okay. Well, good evening, everybody, and welcome to another question of the day of the KripenTalk Stock Market News. I am once again honored to be here. My name is Elias. I am the founder of the KripenTalk Stock Market News, and the KripenTalk Stock Market News, it is basically a podcast in which I summarize and explain every trading day so that you can spot the bull in every scenario. Now, this YouTube channel is a new concept that I thought about. And what I do is I basically answer a certain question of the day every weekday. And those questions are highly relevant at the moment, highly applicable to the economy and to markets in general. Now, today's question of the day, also very interesting, highly applicable, highly relevant. Is the Federal Reserve too data dependent? Now, let me break this question down a little bit so you know what I'm talking about. Now, when I talk about a data-dependent Fed, what I mean is, obviously, because of very high inflation, the Federal Reserve started to significantly raise interest rates. Now, being data-dependent means the Federal Reserve looks at every single data point of the economy, for example, payrolls number, wage inflation, the unemployment rate, core PCE, core CPI, just in general, all the economic data. And based on that data, they make a decision about the further development of monetary policy. Now, there are two main issues when the Federal Reserve is too data dependent. Now, one is general volatility. Just ignore this part very quickly. The first problem is general volatility in capital markets. And the second issue is the risk of making a wrong decision about monetary policy. That is another risk. And then what I will also talk about is a solution, which is basically that the Fed has to get anchored to a certain strategy, which I will explain. I explained it in the previous videos as well, so I apologize if I sound like a broken record here. But obviously, this is a very important topic, so I will reiterate it once again in today's question of the day. Now, the fact that the Fed is so data dependent creates a lot of volatility in markets. Now, what the markets are basically, this puts a data-dependent Fed puts markets in a very problematic situation, because every time a data point is released, the markets are thinking or they are considering what that data point could mean for the further development of monetary policy, right? So, for example, in the most recent labor market report, we saw the unemployment rate fall to 3.5%. So markets basically, once that data point is released, they think about what this data point could mean for the further development of interest rates, right? Now, the problem is the data is incredibly mixed at the moment. If I kind of go back, if we look back at the previous couple of weeks, maybe 3 weeks ago, I don't quite remember when the labor market report was released, but that week, the labor market data was released on Friday, and throughout the week, we got very mixed data. For example, we started off the week with a ADP with PMI manufacturing data that came in lower than expected. Then we had an ADP payrolls number that showed more weakening in the labor market than anticipated by markets or than already priced in. And then the third data point that we got was basically initial jobless claims rising higher than anticipated. So based on this data, the 2-year Treasury yield significantly declined because investors believed, hey, we might start to see economic weakness now, so we will invest in safe bonds, which will obviously push up the price of bonds and decrease the yield on treasuries, especially on the very policy-sensitive 2-year Treasury yield. But then on Friday, that was basically the Friday after all of that data was released. It was all of this happened in the same week. The labor market data was released, all of the labor market data. And what this data showed is wage inflation is starting to come down, but it is very resilient. The payrolls number is very resilient. And in fact, the unemployment rate fell to 3.5%. So the labor market data was still showing an incredibly resilient economy. And for example, Mohamed El-Erian, after that labor market report was released, he said that this data shows that markets should be less worried about the economy and more worried about further interest rate hikes. So the data is incredibly mixed. And this means that sometimes the data is maybe indicating that the Fed should cut rates sooner, and markets react to that in a certain way. And sometimes the data is indicating a very resilient economy. And then that would mean that the Fed has to stay more hawkish and keep rates at a higher level for longer. So this data that is so mixed obviously creates a lot of volatility in the markets, because markets are always reacting to that data in a certain way. Now, why is this a problem? The fact that we are seeing this immense volatility in the 2-year treasury yield, that makes cash management very hard. So all of this volatility that we are seeing is, of course, a big problem for markets in general. And hence, this volatility might be an indication that the Federal Reserve is too data dependent. And what could be done about it, I will talk about here in the third point. Now, the second issue is, I believe it increases the risk of a wrong decision. Now, a couple of weeks ago, the Cleveland Federal Reserve president said once again that the Federal Reserve is very data dependent, and based on the data that is being released, they will make further decisions about monetary policy. Now, after the data was released, Leffa Tengler, she's investment CEO of BNY Mellon Investment, and also the CIO of that company, Nancy Tengler, they were both on Yahoo Finance for an interview. And what they basically said is that the economic data is backward looking. Now, that makes a lot of sense. If you think about it, monetary policy affects the economy with a significant lag, meaning that the Federal Reserve starts to increase interest rates, but this rise in interest rates affects the real economy maybe only with a delay of as much as 12 months. So the data that we're seeing now might not be representative of the damage that will be done to the economy, or the full damage, the full effect that these interest rate hikes will have on the economy. So right now, the Federal Reserve is at the end of its current interest rate hike cycle. We will probably most likely see another 25 basis point rate hike next month. So in May, that is already coming up soon and will be very interesting. So what the Fed is doing is they're looking at data. Based on that data, they might decide, the data maybe will show a very resilient economy. And based on that, the Federal Reserve will say, hey, we're going to raise rates further. But in fact, that might do more damage than needed to the economy, because the data is backward looking. And maybe the Federal Reserve should pause instead of hiking and see or let the previous interest rate hikes affect the economy and have their full effect on the economy. So being dependent on data increases the risk of making a wrong decision, because the data is backward looking and it does not show you the full effect that interest rates already had or will have in the future on the economy. Now, what can be done about this? So I am in the camp of people that believe the Federal Reserve needs to keep rates at a higher level for longer. If you look at and I have to explain this because all of this basically comes down to this being anchored to a certain strategy. Now, what we're seeing right now is in the current earnings season, Coca-Cola, Pepsi, Procter & Gamble, all of these companies are raising their prices, and they're still able to do that. For example, Procter & Gamble, already talked about this yesterday. Procter & Gamble, they were able to raise their prices significantly. Now, their sales volume did fall by 3%, but their sales revenue increased by 4%. So this means that companies are still able to pass on higher prices to consumers, which, of course, these higher prices have inflationary pressures. So companies have been able to increase their margins because the consumer is so resilient. So in order to get the inflation back to the 2% target, the consumer needs to lose some of his or her resilience. Now, what does this mean for the Federal Reserve? This is, for example, one strategy that the Federal Reserve could be anchored to. Mohamed El-Erian said this as well a couple of days ago. I believe that we live in a world of deficient aggregate supply, meaning that there's not enough supply out there. Many companies suffer under supply chain issues that allows them to raise their prices, maybe usually by even more than by how much their production costs increased. And they're able to increase their prices. They are able to pass on these prices to consumers. And that makes it very hard for the Federal Reserve to restore price stability. So let's say the Federal Reserve is anchored to that strategy. Let's say the Federal Reserve is going out there and they're making it clear, we believe that we live in a world of deficient aggregate supply, and hence we will keep rates higher for longer because we need to weaken the economy enough in order to realign aggregate supply and aggregate demand. We need to put these two forces back into equilibrium. So if the Fed is anchored to that situation, the markets don't have to interpret every single data point anymore. If we see maybe a little weaker than expected ADP payrolls number, the markets know we don't have to interpret this data in a certain way. We don't have to think about how this data will affect further monetary policy, because we know that the Fed is anchored to the belief that we live in a world of deficient aggregate supply. So all of this volatility we have seen, for example, in the 2-year Treasury yield, which is very, very damaging. This volatility is very damaging to cash management. It is also negatively impacting the economy. All of this volatility could be erased if the Fed would make it clear that they are anchored to a certain strategy, to a certain belief. Now, of course, I can stand here easily and say this, right? Because I have an opinion. I believe we live in a world of deficient aggregate supply, but I'm only an economics student, right? I can't even call myself an economist yet. So it is hard it is easy for me to stand here and say this, but of course it is very hard for the Fed to pick a strategy that they could be anchored to. And the fact that we simply coming out of the pandemic, consumers have record high savings. Some areas of the economy are showing weakness. Other areas of the economy are showing incredible resilience. Headline inflation is coming down, but core inflation is still very sticky. So all of these mixed signals is causing a lot of problems for the Fed. So to a certain extent, I completely understand that the Fed at the moment has no choice but to be data dependent. But it would simply just being anchored to a strategy. We have so many smart economists out there, so many smart analysts. Just being anchored to some sort of strategy, a very, very carefully picked strategy, would significantly reduce volatility, and it would make life easier for us. It would make life easier for all of us. Of course, it is a certain gamble, right? Because you don't really know if that strategy you're anchored to is correct. But it would certainly spare a lot of damage, and it might even decrease the risk of making a wrong decision. It might decrease it, because being so dependent on mixed data obviously increases the risk of making a wrong decision about monetary policy. Now, I hope this all made sense to you. That is basically, I said everything that I had to say about today's question of the day. I don't have any more, not much more easily presentable knowledge about this topic. So yeah, I hope you enjoyed today's question of the day. Tomorrow, another question of the day will be released, and I still need to figure out what exactly I will talk about. But I hope you enjoyed today's question of the day. If you want me to talk about a certain topic, just simply write it. Just simply write it in the comments of this video, and I will answer that question for you. Now, yeah, like I said, tomorrow at around the same time, a new question of the day will be released. Also, make sure to listen to our podcast tonight, Kriependruck Stock Market News, available on Spotify, Apple Music, or wherever you get your podcasts. So make sure to tune into tonight's episode. We will, of course, summarize and explain the trading day so that you can spot the bull in every scenario. Now, see you tonight, and hopefully see you tomorrow again in another question of the day, and have a great evening.